For a lot of traders, the thing that gets tough is, what do I want to do with the market? And what time frame do I want to do that on? So the first thing we want to determine is the three main kinds of market participation, right? So let's get that out of the way. And that makes every decision. By the way, clarity is the map. If we don't have a clear map, we're in big trouble. So day trading, really simply, and I think a lot of you probably know this, is just this, is being flat by the end of the session. That's it, right? Now you might say, what's the session? For stock and ETF traders, you need to be flat. That means with no position by 4 p.m. Eastern. If you're a futures trader in the indices, that's 4:15 p.m. Eastern. But whatever the session is for your market, maybe it's cocoa, right? What is the session for your market? You need to be flat by then without a position. Just means that when we roll to the next session, we're starting with a clean slate. We're starting with no position. And there's a lot of value in that, but it's a very speculative, very short-term approach. I frankly don't believe day trading is for everybody. And the reason for that, by the way, is the speed of the data coming at you, the speed at which you need to be able to put in your orders, and the number of decisions you're going to make. These need to be done, as I like to call it, at the helm. This is a very at the helm, hands on the keyboard, hands on the mouse type style, right? Then we get into swing trading. Now, a lot of folks define swing trading, and by the way, day trading and even investing with time. I'm not necessarily a fan of that. I'm not a fan of it at all, you know. Market behavior is, for me, what dictates whether I do anything, not necessarily time. So swing trading is, for me, right, and I may be a minority in this, but just so you know, when I talk about swing trading, is for me, usually, but not always, a daily chart conversation. It's a daily chart. Starts with a daily chart. So it's daily chart trading using the swings, right, in the market. Now, that swing could be moving lower to oversold support, right? That swing could be moving higher to a mean reversion, right? A retracement in a downtrend. So swing trading is literally trading the swings. It is literally, for me, trading the swings. I'll correct that typo. And I think, again, if you think about what it is you want to do, it doesn't have to be trend following, although trend following swing trading is my favorite. So here's a downtrend in the NASDAQ. What would be a swing? That's the swing. That's a mean reversion of a downtrend. Here's another mean reversion of a downtrend. What about looking at, say, crude oil, which I would not consider in a trend right now. I really would not consider it in a trend. It's in a neutral, choppy environment. I would consider these two support levels to be potentially support. And the question then becomes, is it oversold? What would I use to understand if it's oversold? A slow stochastic. A slow stochastic. Or any kind of oscillator of your choice. I love a slow sto. I've customized one with particular settings, which you can do the same. Slow stochastic, 21K, 3D. Oversold would be at or below 20. That could be a type of swing. In this case, that move into a support zone that we would presume could then bounce, right? So oversold support. All right, then that brings us to finally, and I'm going to move the weekly chart over. And a lot of traders won't necessarily think about a weekly chart that much, and that's too bad. I like to put the word trading when it comes to positions, because I do believe that position trading is well, first of all, it's a position, is, in my approach, is done on a weekly chart. Weekly chart. By the way, day trading doesn't have to be on any particular time frame. Notice I did not put a time frame there, even though I put a time frame on the swing. Position trading is, for me, done on a weekly chart. Now, I get a lot of questions. What's the difference between, say, investing and position trading? If you're an investor, your primary goal is to, whether that be via dollar cost averaging, whether that be via dividend reinvestment, you're actually focused on accumulating shares. Maybe not in a way that has timing, maybe not in a way that is in any way really focused on the price you're buying. You just want to accumulate more shares. Maybe that's fractionally, maybe that's just share by share, but that is the goal. Trading is about price movement. You're looking to capitalize on price moving either higher in your favor or lower in your favor, depending on whether you're long or short. But it's really about the price movement. You're not necessarily looking to accumulate shares. And if you are, it's because there's a brand new setup, and each one of those setups is independent from each other. And you might have a number of positions in the same symbol in your account, but it really is a setup that got you in, and you have a stop loss, right? Trading does suggest a stop loss. There is a point at which I'll say, nope, won't hold this anymore. While in investing, that really does not usually come up. This conversation of day trading versus swing trading versus position trading or investing in this environment might be the most important we could possibly have, because I'll just for a moment tell you what most of my focus is on right now. It is on day trading. Markets are quite choppy. We're in the middle of a macroeconomic flux, meaning what is the Federal Reserve going to do? Are they going to hike less than what was expected? What is the pace? When do we peak? And at what point can we start even thinking way ahead as to when they're going to start to cut rates? Because why do we hike them? Well, of course, to have them cut. Once the rate, monetary policy and the rate cut start becoming part of the conversation, then the equity markets will be, well, happy days are here again, right? That's the cycle everyone is expecting. That whole process doesn't play out in a day trade. It doesn't play out even on the daily time frame. That plays out on the weekly. So you'll notice when I look at my layout, I have each one of these, the day trading, the swing trading, and the position trading time frames always on my screen. And I think those small habits make a huge difference. So I'm looking at the XLK right now. If you're an index futures trader, or if you're looking at the broader averages, Dow, S&P, NASDAQ, no sector is actually more important than tech. I would say followed by financials and then followed by healthcare. Those three would give you the biggest understanding of what's happening at the broader averages. So of course, the daily and the weekly trends are in play there as well. But this conversation hopefully clarifies my goals as a trader, at least what each time frame is designed to do, and maybe gets you asking yourself, am I doing all three of these? Because all three of these, I believe, are part of a well-rounded approach. And then even additionally asking, well, which time frame do I prefer? Do you have to use the time frames I'm using? Of course not. But what time frame do I prefer for my investing / position trading? What time frame do I prefer for swing trading? Maybe it's a 1 hour, maybe it's a 2-4 hour, right? And which time frame do I prefer, if you're going to, for day trading? Maybe it's a 1 minute, 2 minute, 5 minute. I prefer a 5. Once you know what you're doing and what time frame you're doing it on, that alone is going to make a sea change in the way that you approach the market. So I hope that helps, and I hope that conversation is something that you can take right now and start to make practical.
Hey traders, Raghi from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.